So a few of the most common mistakes we see are entrepreneurs overestimating the experience of their team. Almost every presentation starts out with a statement about how strong the team is, and that occurs even when it's two engineers and a dog. So my experience is that if you're working with a good venture firm, they can help you round out the team. So you don't need to overstate that coming in if it's a very early stage idea. Another area that I think entrepreneurs underestimate is the financing risk. I think everyone understands how early it is to raise that first round of money, but we look at it in our investments of how are we going to cover the entire amount that's going to be raised. So we're doing more 2- to 3-handed deals, fewer deals where we're the sole investor. And that's a way to minimize the downstream financing risk and hopefully having enough money around the table. So we're bringing corporate venture capital in earlier as another means of managing that downside risk. So one of the challenges we also see is entrepreneurs minimizing the challenge of reimbursement. 10 years ago, if you had a project that was working clinically, you would be able to ultimately get it reimbursed. That just isn't any longer the case. These projects, to get reimbursement, require multiple clinical trials that are expensive, and it needs to be studied in patients that are over 65 years old for CMS to provide reimbursement coverage. So they're getting much tougher, as are the private insurance companies. So what we see in many cases is, or we like to see, is companies that are focused in areas that are already reimbursed or in markets that are self-pay. For example, the aesthetics market and ophthalmology are often markets where self-pay has allowed companies to get funded because you've taken that reimbursement risk off the table.